Hi, I'm Ken Frier, Chief Investment Officer of Atlas Capital Advisors. It's July 2025. In this video, I'll explain why TIPS, Treasury Inflation-Protected Securities, have become a quite attractive investment for retirement portfolios. The main points of this video are, for retirees, TIPS are really the lowest risk asset. Long-term TIPS yields have never been higher than they are now. Retiree spending plans starting at 4% or higher can now be obtained with no risk of running out of money thanks to these TIPS yields. And the expected return on TIPS has nearly reached the expected return on U.S. stocks. For retirees, the goal is to maintain a standard of living without running out of money. That requires an investment portfolio that will deliver a higher return than the rate of inflation. The chart shows over the last century the 10-year return relative to inflation, or the real return, for investments in the S&P 500 and in the 10-year U.S. Treasury note. You can see that the return of U.S. stocks and of U.S. bonds has usually been positive, that is, above inflation, and sometimes, especially for stocks, a lot better than inflation, but not always. The 10-year real return of stocks was negative after the stock bubble in 1929, the tech boom in the late 60s, the tech boom in the late 90s, and the 10-year return on bonds was negative real return for most of the 1930s through the 1970s and in recent years. With TIPS, if the coupon is positive, then the investor knows for sure that the future return will be higher than inflation, and that makes it a less risky choice for retirees. TIPS provide a low level of risk, but they've not always provided a high return. Fortunately for investors, that has changed. As the chart shows, the yield on the 30-year TIP in July 2025 is 2.65%. That's the highest ever. An investor in that bond has a guaranteed return of 2.65% more than consumer price inflation over the next 30 years. So for instance, if CPI went up by 3% per year, the investor in the 30-year bond would obtain 5.65% per year. The 10-year TIP yield is now over 2% per year, and that's the best since 2008. The best known retirement spending advice is called the 4% rule. You invest in a balanced portfolio split between stocks and nominal bonds. You spend 4% of your retirement savings in the year that you retire, and then you raise your spending each year by the amount of inflation. This strategy is said to provide about a 90% probability of going 30 years without running out of money. But suppose you could create a portfolio invested entirely in TIPS with laddered maturities over the next 30 years and a blended real return of 2.5% over inflation. That investment strategy would permit you to spend more, 4.8% of your assets in the first year, rising with inflation. Moreover, you would be 100% certain that the assets in your portfolio would last you for 30 years. The chart here shows the relationship between the real return of your TIPS portfolio and a spending plan that will last 30 years. So clearly, the more the real yield on the TIPS, the higher is the rate of spending that you can achieve. Now we'll shift gears for a bit and talk about the U.S. stock market. Most retirees prefer U.S. stocks over TIPS in their retirement portfolios because they expect a higher future return from the stock market. But what if the return from stocks is not going to be much higher than the return from TIPS? A reasonable way to estimate the future real return of stocks is to use the long-term earnings to price ratio. That's the average real earnings of the S&P 500 index over the past 10 years divided by the current index price. As observed by the Nobel laureate Robert Shiller, the starting earnings to price ratio has had a strong relationship to the future real return. In this chart, using the data from 1915 to 2015, we divide the initial earnings to price ratio into deciles, and then we show the average real return over the following 10 years. It's a close relationship. On average, the future real return has been about the same as the starting earnings to price. That earnings to price ratio now is really low. It's just 2.7% in the bottom half of the bottom decile. In this chart, we compare the long-term earnings to price of the S&P 500 stock market index to the real returns available from 30-year and 10-year tips. The yield on tips has nearly closed the gap. If the earnings to price ratio of stocks indicates the middle of the distribution for the real return over the next 10 years, we're verging on a 50% probability that an investment in tips would do as well as an investment in stocks, while presenting much less risk. And so to summarize, this is a good time to review the allocation to long-term tips in your retirement savings account. At current yields, a larger allocation to long-term tips could provide both more certainty in long-term investment outcomes and the potential to safely spend a higher proportion of your retirement assets. Moreover, moving assets from U.S. stocks to tips would lower your risk significantly while potentially having a negligible negative impact on your return in the next decade. So thank you for listening. There's much to unpack here, and we'd be glad to answer your questions. At Atlas Capital, our focus is on keeping implementation costs low and making favorable asset allocation decisions. So to get other recent market commentary, you may watch the market commentary playlist on this channel, and you may subscribe to be notified as soon as the latest is posted. You may also visit our website at atlasca.com to have access to our investment philosophy and latest views. Thank you.